What's up YouTube? Welcome back. So you want to know about stock splits, dividends, and penny stocks. Let's check them out. Whenever the companies want to appear more affordable to the general public, they will go through something called stock splitting. And stocks can split in multiple ways: 2-for-1, 3-for-1, 6-for-1, whatever the case may be. So by splitting the stocks, number of shares will increase, will go up, where the price per share will decrease. For example, a 2-to-1 split on a company with 1,000 shares will create 2,000 shares, where the price for each share worth $100 would be slashed to $50. For example, a company's stocks are worth each $1,000. By splitting all the shares that the company has into half, the number of the shares out there will double. However, the price will slash in half, a $500 per share. So if you had one share for $1,000, the next day you will have two shares of the same company, each worth $500. Again, this will not increase the valuation of the company, but only increases the affordability of the general public being able to purchase the shares of that company. And this alone by itself creates a temporary hype about that company, where those who can afford to purchase at the new price will come in and purchase more, and in turn temporarily will drive up the price for the shares with that company. So how is it possible to turn 1 million shares of Walmart, for example, into 2 million shares? By doing a 2-to-1 split, therefore making the prices more affordable for the general public to purchase. But again, the valuation of the company will not change. Now, given the fact that within the past few years, there have been platforms such as Robinhood, Ameritrade, and a few other ones that are starting to allow fractional share purchases. This fractional share purchases allows smaller investors who cannot afford to buy stocks that they want to purchase at full price to come in and purchase them at fraction of a stock. For instance, if a Tesla is worth $700, they can purchase of whatever amount of less than that amount, maybe $100 worth of stocks of that company, Tesla. So that's something to keep in mind. But in general, stock splits means that the companies will slash their stocks into whatever portion that they desire to. Apple went splitting 4-for-1 last year. Tesla did similarly to splitting 7-for-1. So again, these companies will break down eventually their stocks to make them more affordable for general public to purchase them. So if you take a look at Google price of today or Amazon prices for today, they're pretty expensive, and people are anxiously waiting for them to split, if they ever split their stock prices, so other investors can pour in and purchase them and add them to their portfolio. So that's in a nutshell, without diving too much into details of stock splits. Now, with that being said, let's talk about dividends, right? Dividend is a token of appreciation basically for an investor. Companies who have expanded beyond the means of their goals, they have achieved all their targets and goals and are sitting on a whole bunch of pile of cash, and they do not want to expand furthermore, they will come in and allocate a portion of their revenue returned to the investors in the form of dividends. Companies such as, let's say, Ford, Coca-Cola, any company that pays out dividends, they don't want to expand as rapidly as they have been expanding within their past years. Now they're sitting on a whole bunch of cash, and basically they don't know what to do with it, right? On the other hand, they have the option of reinvesting into the company, which they still do, but not as rapidly growing within the past years. But also they want to attract more investors. So what they do, they start paying out dividends on quarterly basis. So anyone who owns a certain number of shares of that company will get a quarterly payout. This is a very useful concept for those who are are near retirement or are specifically looking for retirement or post-retirement income. The problem with that is, as going through market fluctuations, economy fluctuations, these companies might readjust or eliminate their dividend payouts. And this can be very dangerous for those investors who rely on dividend payouts for their livelihood, such as retirees. Therefore, with the slightest hint of adjusting dividend payouts, you see a frenzy of sell-offs with those stocks typically, where people who rely on dividend payouts would sell off in order to get out of those portfolios and take their investment to other companies who do pay dividends. So this is something tricky, and for those who monitor the market evaluation and volatility in the market is important telltale signs of when to get out of a particular stock. So who should really focus on dividend paying stocks? The younger generation should not really focus on the dividend paying stocks simply for the fact that they have the time on their side. So it's recommended that the younger generation would invest in portfolios in stocks and companies who are in the stages of growth, who have the potential to grow further and become bigger and more successful. And therefore, when you enter at the lower price point with their stock pricing and stay with them for a longer period of time, in turn, when their stock prices appreciate throughout the years, portfolio grows with them. People who don't have the luxury of time on their side, namely our retirees, they don't want to take that risk because yes, it sounds fantastic to stay with a company that is growing, but at the same time, they don't pay no dividend, number one, and number two, they might fold and wipe you out of your retirement funds or investment. So let's say, why would somebody invest in Coca-Cola who does pay regular dividends? See, that is the challenge. And to reiterate, a company like Coca-Cola has expanded beyond what it wants to do. It's almost present in every country. So this company has grown to the extent that basically can grow no more unless it has to diversify into other ventures. In a nutshell, the company has grown where it needed to grow. So they will start paying dividend to attract more shareholders, but at the same time to maintain the existing shareholders. But a company like Under Armour has room to grow, therefore doesn't see the need to pay dividend on regular basis. So penny stocks. What are penny stocks? Penny stocks are stocks that sometimes can be purchased for the fraction of a penny, therefore making it more appealing to novice investors. It sounds very appealing because out of a sudden you can own 1,000 shares of X company for a few dollars. But the challenge is you have to look at the fundamentals. Why this company is trading on a penny stock supported platform, not why they are not on a New York Stock Exchange or NASDAQ. The reason for that is oftentimes these companies are very small and therefore they do not meet the requirement of the SEC or the stock exchange, the major stock exchange, to qualify to be represented on those platforms. This makes them that much dangerous because a stock that has minimum supervision on it, you don't want to be part of. And on top of that, Wall Street analysts do not cover penny stock companies. Few factors here. Number one, they are not traded on the regular platforms that most other stocks will trade off. They are not governed by SEC properly, and the Wall Street analysts don't cover them. Therefore, there's minimal supervision besides the newsletter or the marketing that those companies put out. And this makes them that much more volatile to market. Now, oftentimes investors get into these penny stocks with hopes of scoring overnight wealth, and sometimes they do, but more often they end up losing their money. And this is where the term pump and dump come in. Pump and dump is when an investor comes in and purchases a massive amount of shares of this company and drives the price up temporarily because of that purchase. And therefore they would steer a frenzy of social media, networking, newsletters, calling on investors, any type of networking, encouraging the investors to come in and purchase, which in return will increase the prices of those shares even further up and up and up, which can be referred to as a pump. Once the price has reached to the level that that initial investor who came in and purchased, let's say, millions of these penny stock to that desired level, they will sell off and get out of the position. And that's when the term dump come in. So These penny stocks are very dangerous. It's highly recommended that novice investors stay out of them. People lose their money in a heartbeat in penny stocks, especially if you are working with a large capital. You can lose it in a heartbeat, just at the time where you think the price is at the lowest of the lowest. I guarantee you it can go lower than that. So just be careful. Guys, I hope you have enjoyed the video. Leave me a comment, hit that like button, and subscribe for more videos coming on the stock market, financial analysis, and basic everyday finance terminology explained. Have a good one.